Procter Gamble shares edging lower after the company topped earnings estimates in its fourth fiscal quarter, but it did warn of a $1 billion tariff hit and more cautious consumers. I sat down with Chairman and CEO Jon Moeller to discuss the quarter as well as his decision to step down at the end of the year.
Well, as of January 1st, when I step into the executive chair role, I will have served this company for 38 years. My wife also worked here as a senior executive until she retired when I became CEO. And between the two of us, we've served for 7 decades, or almost 3/4 of a century. We've, over the last period of time, if you look at the last 7 years since we implemented our strategy, results have been very strong. Organic sales, or sales, up $17.5 billion over that period of time, 84th percentile of the S&P 500. Profit up $6 billion, 92nd percentile of the S&P 500. $180 billion in incremental market cap, which is more value creation over that 7 years than all but one of our competitors have created over their 1 and 2 century histories. The team has created the 18th most valuable publicly traded company in the US, the 21st most valuable in the world. And on the back of those results, I feel very comfortable handing over the reins to a fantastic leader, Shailesh Jejurikar, who I've worked with for decades. He and I worked very closely recently. He was the COO of the company. I was the CEO. And so it just seems, as the calendar year passes, like a good time to pass the baton to the leader of the next phase of growth and value creation for the company.
When I think, I look at your portfolio, Jon, I see Tide. Tide, I think premium product. Then I see Gain, solid product. I've used it in the past, but maybe priced a little bit cheaper than a Tide. Are you seeing that trade down from consumers?
We are seeing modest trade down within our branded portfolio. So within the different Tide offerings, there are some that are more premium than others, and we are seeing some trade down there. We're also seeing some trade down to brands that you mentioned, like Gain. We are not seeing any trade down as of yet to private label. Private label shares in both North America and Europe are down if you look at the last 12 months or even more recent periods. So consumers continue to understand the value that's contributed by performance. Remember, when we did that big portfolio consolidation that you talked about, there were 2 strategic objectives associated with that. One is to concentrate our portfolio in categories that were used daily, or even more than once a day by consumers. The second was to concentrate our portfolio into categories where performance drives brand choice. And that's held up extraordinarily well and puts us in a much better place as we move forward. I mentioned there is some trade down within the portfolio, but there also is continued trade up. And we find that whenever we can bring stronger performance that enhances relevancy for consumers and increases value, good things happen, and we have a big year of innovation ahead of us.
$1 billion tariff hit P&G is calling out for its new fiscal year. That's a very large number, I don't have to tell you that. But within that number, are you taking price increases to offset that type of hit?
There will be some price increases, and I think I mentioned that last quarter. Though we're going to try to combine those, as I just described, with innovation, so that the total value proposition to consumers, the benefit they think they're receiving for that slightly higher outlay is accretive. So you will see some increases over time. We're also working hard, as I mentioned earlier in our discussion, to reduce costs to minimize the impact of those price increases, but there will be some.
Lastly, Jon, the trade situation has cooled down just a touch, I would argue, compared to when I last talked to you. This $1 billion hit, is this a worst case scenario and we might see less of hit moving forward and perhaps less inflation as a result of these tariffs?
We've tried to be as reasonable as we can be, given the current information that we have and the current state of discussions around the world in our forecast of the tariffs. So they could go, frankly, either way. at this point. Look, I want to step back on this. We understandably get kind of focused on single variables within the broad economic equation, and then I'll come back to tariffs. But if I look at the level of dialogue and openness on the part of the administration, the Hill, I've never seen it as productive as it is now. So there are ongoing discussions, two-way discussions all the time with policymakers trying to understand what the right path forward is. And in my view, on the corporate tax front, they got it precisely right. With the growth incentives that are built into the most recent bill. We've made progress on, as you indicate, on the state of tariffs and how they're applied. And I have confidence that we'll continue to move in the right direction. The biggest thing for us is tariffs on naturally sourced ingredients that don't have a U.S. substitute. So, for example, psyllium is the active product. The husk of the psyllium seed is the active product in Metamucil, which we produce 100% of the world's supply in a plant in Arizona. You can't grow psyllium, I think we talked this last time, in the U.S. climate. And so by imposing a tariff on that and other naturally sourced materials that don't have a domestic alternative, you incent companies to potentially move production out of the U.S., which isn't what anybody wants. And we're fully supportive of the direction to try to enhance the environment for U.S. manufacturing. So those are some details that need to be worked through, but I feel comfortable the collective we are making progress in that regard.
Jon, real quick follow-up. Then do you view tariffs as inflationary? I mean, you're calling out this big $1 billion hit, and you're taking some price increases in the portfolio. I mean, where do you stand on this one?
That's become a bad word, but I won't avoid it because of that. It is inherently inflationary. It increases the cost of importation, and that's part of the policy design. And in some places that makes a lot of sense, but it inherently increases cost. And then, manufacturers need to work through how much of that they can absorb and deal with and how much they need to pass on.